Hello and welcome to my presentation for the ACFE Fraud Awareness Week 2020 about next generation anti-money laundering. I gave this presentation on Monday, November 16th, but due to audio issues of the original recording, I have recorded it again and that's what you're now listening to. My name is Eugène van Kampen and I'm a customer advisor at software company SaaS Institute, which is headquartered in Cary, North Carolina in the US, has offices around the world and was founded in 1976. Today, SaaS is still a privately owned company providing analytical software used to analyze data in multiple industries and for different purposes, for example, combating financial crime and fraud. I've been working for SaaS for over 8 years now and am based in the Netherlands. Prior to SaaS, I worked for other software vendors, providing software for controlling operational risk and for combating financial crime as well. I work with internationally operating clients in the financial services industry and advise on how SaaS software can help in their day-to-day challenges fighting financial crime. I have a computer science degree from Twente University and am CAMS certified with ACAMS since 2008. Let me start my presentation with two statements from the United Nations Office on Drugs and Crime that you can find on their website today. The first is that with today's technology, money flows across the globe faster and easier increasingly. And with the ongoing digitalization, money trails get obfuscated more easily. Second, that they estimated the amount of money being laundered globally per annum is 2 to 5% of global GDP, which means a total amount ranging from 800 billion to 2 trillion USD. That means 2.2 billion USD to 5.5 billion USD per day. And those numbers most likely are not even accurate anymore. Because if you look up the world GDP for 2019 today, for example, on data.worldbank.org, it was 87 trillion USD. And if the 2 and 5% are correct estimates, the total amount of money being laundered globally would even range between 1.75 and 4.4 trillion USD. And though there is a huge margin between those two figures, even the lower figure shows how serious this is. So what do I have in mind to share with you today? First, I would like to speak shortly about some common trends that we see in the market and among financial institutions. Next, I will briefly zoom in on some developments in the EU with regards to regulators and regulations, followed by a number of common challenges that we see that clients and other financial services provider we speak with struggle with daily in the compliance domain. And then finally, I will focus on next generation AML or modernizing your AML program, mainly from a software perspective. After all, I'm working for a software vendor, and in particular, what we see as key components needed for moving towards next generation AML and key criteria for a successful modernization of your AML program. I will close my presentation with two sample use cases about modernization. An interesting book I've read is Bank 4.0 Banking Everywhere Never at a Bank from Brett King. King is monitoring the financial market developments for years already and updates his book periodically. In the latest version, he advises traditional banks to go back to the drawing table to change their core business model. King predicts that if banks stick to banking through the branch, they will be out of business in the foreseeable future because the financial services business will be fully taken over by technology-led companies like M-Pesa, Ant Financial's Alipay, Tencent's WeChat, or Paytm. Financial services providers need to go digital because customers expect more and more low friction, low latency engagement. However, he does see enormous challenges for traditional banks since they have so much legacy. Then the European Union continues to tighten its grip on money laundering. Regulations get adapted more frequently to new market developments and new criminal trends. Since the first anti-money laundering directive was enacted in the EU or by the EU in 1991, we are now at the fifth, amending the fourth that was published in 2017. And the fifth came into force January 10th this year, and the sixth is already underway, planned to come into force by December 2021. The fifth anti-money laundering directive includes some lessons learned from the Paris and Brussels terrorist attacks and the Panama Papers, plus it adds focus on technology innovation. Some important regulations from the fifth anti-money laundering directive include The reduction of anonymity on electronic money products like e-money and prepaid cards, those are considered instruments often used in terrorism financing, especially online. Wallet providers and virtual currency exchanges will fall under AML laws as they have been added as new obliged entities. The beneficial ownership registers for legal entities such as companies will become public. Any member of the general public can access basic information without the need to demonstrate a legitimate interest. Next, the access to data on the beneficial owner of trusts will be accessible without any restrictions to competent authorities and will be accessible to other persons who can demonstrate a legitimate interest. And finally, the EU financial intelligence units will have access to more information through centralized bank and payment account registers or data retrieval systems. The FIUs from the different EU countries will also be able to cooperate more easily, as well as with other competent authorities. Furthermore, with all these tightened regulations and heavy financial penalties given the last few years, financial institutions hire more people to work in their compliance processes to minimize the risk of being non-compliant with those regulations, and with that the risk of being fined as well, or maybe even again, and because of that losing reputation and shareholder value. The consequence, of course, is that the cost of compliance is increasing dramatically. The last few days there were articles in the Dutch news about bot armies that spread 45,000 fake news messages recently on social media against the possible independence of West Papua from Indonesia. Fake accounts that spread fake news on Twitter, Facebook, Instagram and YouTube in Indonesian language, but also in English, Dutch and even German. And it's not that fake news is new today that I mention it, but I just want to show you how easy it is, for example, to create a fake profile picture with AI technology. Later on in my presentation, I will talk about how AI can be used to modernize your AML program. But with new technology, of course, also it is available to criminals. Simply go to www.thispersondoesn'texist.com to see that with every refresh of the page, you get a new picture. That it isn't always a perfect image, you can see at this example, where the down right part of this image has not been correctly generated. But then again, simply refresh the browser page to get a new image. And let me show you how that works. Here you can see the page, and if I click on refresh, you get a new picture every time. That's how easy it is. As a next topic, let's have a look how the regulatory framework is set up in the EU. Where the European Commission is responsible for proposing legislation, implementing decisions, upholding the EU treaties and managing the day-to-day business of the EU, the European Banking Authority, established in 2011, is an independent EU authority which works to ensure effective and consistent prudential regulation and supervision across the European banking sector. So that includes the guidelines for the member states for the prevention of money laundering and terrorism financing, beside things like conducting stress testing and identifying weaknesses in banks' capital structures. Member states have their own regulatory bodies or AML supervisors, like the Dutch Central Bank and the Authority for the Financial Markets in the Netherlands, or the National Bank and the Financial Services and Markets Authority in Belgium, the FSMA, who do the supervision on the obliged entities in their respective member state to monitor that they comply with the regulations. The obliged entities must identify and report all suspicious activities, sanctions violations and other risky situations to the member state's FIU, who further investigate and share information among others with other FIUs in other member states. If the FIU has confirmation of financial crime, it sends it to law enforcement, who can then take it to court for prosecution. Latest developments in the EU show strong intensification of the fight against money laundering and terrorism financing. For example, in July 2019, the European Commission has adopted strong communication towards better implementation of the EU's anti-money laundering framework. And in February 2020, the European Banking Authority were given more authorization to lead, coordinate and monitor the AML efforts of all EU financial services providers and competent authorities. A separate organization is the EBF, the European Banking Federation, founded in 1960, uniting 32 national bank organizations who represent approximately 3,500 banks. They have made their own assessment of how to deliver on the promise of a more effective way of fighting financial crime in the EU and have identified 4 priority areas that need to be addressed, resulting in 20 concrete EU policy recommendations. They call it the EBF Blueprint, published in March 2020. Since the slides will be shared and you have this recording, you can easily look at the links that are on this slide. And please have a look at them to get more information about what I just referred to. And as I just mentioned, the 6th Anti-Money Laundering Directive is already underway, with an implementation deadline of December 2021. The amendment will again fortify the AML regulations, this time with, among others, subject to change of course, a list of 22 specific predicate offences that must be criminalized by member states, requirements for stronger collaboration between member states for prosecuting money laundering, and also heavier punishments. Let's now focus on some of the common operational challenges that I hear when I'm speaking to clients. Let's first see what I consider key areas for an AML compliance program where these challenges can occur. First of all, a customer journey typically starts off with getting onboarded as a new client when applying for a product or a service. According to KYC policies, a financial institution must get proof of identity, understand the business of the client, his source of funds or wealth, what his financial intentions and expectations are, whether an individual has US citizenship for FATCA reasons, for example, and so on. If the client is a legal entity, it's key to understand what the company structure is and who the ultimate beneficial owners of the company are, typically relying on information from external data sources like the Chamber of Commerce or Open Corporates, or commercial data providers like Dun & Bradstreet, Bureau van Dijk, Kicker. The client and any beneficial owners need to get screened for sanctions and PEP, and typically a compliance or KYC risk score is calculated. And this all needs to happen in real time or near real time to make quick decisioning possible. Second, sanctions and PEP screening, but then more from an ongoing perspective. If, for example, watch list or sanctions list contents change, the existing customer population needs to be screened against the delta and vice versa. If customer data changes, the customers with significant change data need to be screened against the full list. From a transaction perspective, payments, for example SWIFT messages and SEPA payments, always need to be screened. Third, ongoing due diligence, and with that I mean the execution of periodic customer risk scoring based on risk classification or time, and the execution of enhanced due diligence in case of unacceptable risk level. Fourth, transaction monitoring, to identify suspicious financial or non-financial activity, deviation from expected behavior or anomaly detection, identifying outliers by peer group analysis based on their financial and non-financial profile, and the monitoring of payments through the bank's correspondent banking network. Fifth, the ability to produce and process alerts about suspicious activity, watchlist matches, or customers with an unacceptable risk level, and efficiently execute enhanced investigation, having a holistic view on the customer's behavior, and as much as possible automated support. Dependent on the requirements of the organization, there might also be a need for having workflow capabilities with 4 eyes principles, for example, so investigators cannot approve their own investigation results. And obviously, all activity should be logged by a proper audit trail. And finally, reporting, both from a regulatory perspective as management information perspective. Automated report generation and ad hoc data analysis are key for management control and efficient reporting to the FIU. Considering the key compliance areas and when speaking with clients and prospects, we hear numerous factors that drive modernization their AML program. We have a top 6. First of all, high volume of false positives, that is false alerts, alerts that are generated but shouldn't be, especially alerts generated for sanctions matches because the matching algorithms are not adequate. And all these alerts need to be processed from a compliance perspective. It might not always be easy to drive down those numbers, but there are definitely opportunities to achieve this. An assessment for such cases might be worthwhile to identify improvement areas. Advanced analytical techniques can help in this, for example, customer segmentation and threshold tuning, or improving your matching algorithms, applying entity resolution to your customer data to find hidden identities, and so on. Second, many organizations still rely on the application of just heuristic deterministic rules. And that's absolutely fine and still valuable. But the downside is, with those kind of rules, you look for the known, that is, the behavior that you already thought about to capture. And that's exactly what criminals also know and try to avoid showing. And with money laundering patterns getting more complex, those might go undetected with rule-based systems. Third, the adoption of applying advanced analytical techniques by regulators is increasing. The hesitation always has been that analytical models are not explainable, that they are a closed box. But the regulators are getting more receptive to these techniques. Financial institutions might not want to be the best in class, but they also certainly don't want to be the worst, because of the earlier mentioned risk of fines and loss of reputation and shareholder value in case of non-compliance. Due to different reasons, you might not have a holistic view of your customers. That could be caused by bad data quality, missing data elements, inaccurate data, having different data sources, for example, multiple customer databases when companies have merged, and with that no unique customer ID, or simply because criminals try to hide their identity and use multiple different profiles when misusing your products and services. In those cases, techniques like entity resolution will help getting a single view on the customer. I already mentioned the increase in compliance costs being a worry. The tick in the box for compliance is needed, but due to increased time required for system implementation, model development, investigation and reporting, more people are being hired, and systems need to be modernized or even replaced, and with that the costs are rising. And finally, financial institutions are sometimes struggling with implementing a well-defined standardized compliance process, causing investigators taking decisions in their own way, making it first of all difficult to improve existing detection models, but also making it difficult to explain to the regulators why and how certain decisions have been taken. Then as a final topic, I would like to dive into modernization of your AML program. What modernization opportunities there are, some learning, some advice, and I will end with two example modernization use cases. If we first look at common techniques and methods that are being used, we see the following. The use of rule-based systems. And as I already said, with the use of heuristic rules, you look for the known suspicious behavior and patterns. If then else conditions is typically what they look like, and dependent on the AML system you use, you either must write programming logic or have more user-friendly point and click or drag and drop capabilities to develop them. They're still valuable, absolutely, because not every criminal is that sophisticated and will still try to launder money via the traditional known methods. When implementing rules, you must make sure to tune them to keep the number of false positives to a minimum and have a maximum number of true positives, that is, the good alerts. Initial threshold setting is an important aspect in this. Tuning can be done in many ways, and we see many improvement opportunities like using analytical techniques to do better customer segmentation and with that better threshold setting. At the end of my presentation, I have a use case demonstrating the value of an optimization project we did. And though this topic is put under the umbrella of best practices already being applied, we still see a lot of improvement opportunities here. As I said earlier as well, sanctions and PEP screening is a compliance requirement that needs to be addressed. However, they do tend to generate most of the false positives because of language complexity and incomplete, limited, or inaccurate data. Then the application of basic analytics. Commonly applied basic analytical techniques include the building and monitoring of entity profiles, like the total number of cash deposits, the total amount of international wires, and so on, and comparing those values with expected behavior and behavior of peer groups to find anomalies and outliers. Network or link analysis we also see quite commonly being applied, especially in fraud detection. Visualization of relationships immediately helps seeing the bigger picture of how relationships go and who are involved. However, the challenge often is how to detect the highest risk networks. Just simple link analysis is just not good enough. Then robotics, if we more look towards next generation AML. Robotics and robotics process automation in particular is used to handle routine processes that can be orchestrated using basic rules. For example, populating an alert file with account and transaction data sourced from multiple systems. Smart process automation joins robotics with artificial intelligence to enable the automation of workflow tasks that require decisions. RPA is already tried out by some financial institutions to add efficiencies to repetitive processes, but automated decisioning by smart robotics still faces challenges in terms of maturity of the technology. Semantic analysis techniques enable the interpretation of unstructured data such as free text fields, for example transaction narratives or information fields in Swift messages, and documents, but also photographs, videos, and audio recordings. In the AML context, natural language processing, or NLP, can be used to extract information about entities in unstructured data sources, including contextual information such as roles and relationships. NLP makes it possible to automatically extract and contextualize the relevant information from large databases as well as from multiple sources. Conversely, natural language generation can automate the creation of narrative documents based on data inputs, for example, the generation of suspicious activity reports. And finally, artificial intelligence. AI provides a range of advanced analytical techniques, including machine learning, smart process automation, and support for automated decision making. Machine learning technologies such as neural networks enable systems to continually improve the results of their detection results, for example, by applying supervised or unsupervised learning, while smart process automation joins robotics with artificial intelligence to enable the automation of workflow tasks and decision making. So many topics that can be focused on when improving your AML program from a software perspective. But it clearly is a journey, and it also depends on the current situation and maturity and capabilities of your organization, what can or should be focused on. Why are AI and machine learning adopted so slowly by organizations? During a previous joint KPMG SaaS webinar about next generation AML organized earlier this year, we did a brief survey among the participants. We first asked the level of applying AI machine learning in the organization. The outcome was that about 40% are still not using any advanced analytical techniques, and only 11% has some kind of AI machine learning in production. What we don't know, however, is what kind of AI machine learning is applied for and for what specific purpose. Then asking the audience why their organizations were hesitant or had difficulty implementing AI machine learning techniques showed a diversity of reasons, from challenges with resources to difficulty with explaining the outcome of the analytical models. To our opinion, there are 5 key components needed for a modernization of your AML program, again from a software perspective. First of all, an integrated open analytics platform, comprehensive in scope, uniting diverse skills, technologies, and data. It should cover all aspects of the analytical lifecycle, from data to discovery to deployment. A powerful in-memory analytics engine that enables processing huge datasets quickly, while incorporating complex techniques like machine learning, deep learning, neural networks. So AML investigators can derive accurate data-driven insights that lead to trusted, consistent decisions and quick action. As a second point, a sophisticated end-to-end anti-money laundering platform that provides transaction monitoring, customer due diligence, real-time sanctions and watchlist screening, and regulatory reporting. The solution should support advanced analytical techniques, AI, machine learning, and robotic process automation to reduce investigation times and help you achieve unprecedented prediction and detection results. To uncover new schemes or detect increasingly sophisticated tactics, you need more than rules and standard analytics. You need sophisticated adaptive techniques like deep learning neural networks, extreme gradient boosting, and vector machines, as well as proven methods like logistic regression or self-organizing maps and random forests. Combining AML techniques is far more accurate and effective than using just one type of analytics or traditional rule-based methods. Most financial institutions have invested heavily in their transaction monitoring platforms. You don't need to replace your existing AML monitoring program to modernize, however. Instead, you can optimize your program by incorporating sophisticated analytical tools, significantly lowering compliance costs while increasing the effectiveness and efficiency of your existing AML monitoring program. And finally, an AML system should offer integrated cloud-ready alert case management and workflow, so you can identify, investigate, and report suspicious activities quickly and efficiently. Its self-service capabilities should let you govern the complete life cycle of your AML investigations. Furthermore, the system should be easy to tailor to your business requirements and provide a user-friendly interface plus a holistic customer view. For the approach to modernize your AML program, we advise the following 10 keys to success. Innovate, but do it cautiously. While regulators are calling for innovative approaches, they also state that innovation should not subject banks to supervisory criticism, even if pilot programs ultimately prove unsuccessful. Establish a rigorous model governance. An AML program should have a proper risk control framework, consisting of the identified threats, the mitigating controls, and the execution of periodic risk assessments to assess the residual risk, identify any issues, and define the actions to solve them. Share data within your organization across borders, but do it securely, taking GDPR into account. We also see collaboration initiatives in countries between financial institutions, like TMNL in the Netherlands, Transaction Monitoring in the Netherlands, in which 5 major banks will be sharing data for transaction monitoring purposes. See if a hybrid approach for detecting criminal behavior is helpful. Use rules where they do the job, use models where rules fall short. Analyze your current data foundation. The adage garbage in is garbage out still applies and is even more crucial when you want to apply AI to your detection models and outcome. You can apply supervised learning to your investigative outcomes, but if they are not consistent or even wrong, so will be your models. Analyze your current customer and product or service segmentation model. Is it granular enough? Making it more granular than simply dividing, for example, customers in personal and commercial ones doesn't allow you to use granular thresholds in your scenarios, which will result in more false positive alerts that you need to investigate. And I'll show you an example of that in about a couple of slides. Apply a risk-based approach to be able to focus on what matters first. Implement auto-referral and hibernation functions to safely put low-risk alerts on hold until they get a higher score. AI can help calculating a risk score to see if the alert is good for investigation. This would save a lot of human investigation effort. Use AI and machine learning to detect more complex and rare events, high-risk networks, and customer behavior that is out of the norm. Supervised learning can be applied to learn from past decisions, while unsupervised learning models can be used to detect, for example, outliers. Find solutions that have analytical capabilities based on best practices built in, ready for the business end user. It should be easy to design, test, validate, and deploy new models. And finally, financial institutions today have various risk functions: fraud, public security, cybersecurity, credit risk, AML, and typically with disparate systems, people, and processes. Data orchestration, analytics development, decisions, case management, reporting, and governance should take place in a unified environment that supports bidirectional communication and synergies among functions. When that happens, we're going to see all of these risk functions be more powerful, more efficient, and more cost effective. I would like to close my presentation with two use cases that demonstrate an example of optimization, which could be a next step in your modernization approach. So optimizing your current AML system without having to throw away the investments you made in it. The first is applying entity resolution to your customer data. In this picture, you see the result of some network analytics. It shows a household entity in purple on the left with members of the household linked to it, a customer household account in orange at the bottom, and money flowing out of the account to counterparty accounts outside the bank with a dotted blue arrow. Linked to those accounts are the counterparty account holders and addresses that were extracted by applying text mining to beneficiary information fields. We also see, for example, that there are multiple counterparties with similar characteristics when zooming in on the top of the network. However, those counterparties have been matched as being similar, after applying fuzzy matching algorithms and comparing other customer characteristics. And where it looks like money is flowing from the household accounts to accounts of 4 different counterparties, it actually turns out that the 4 involved accounts are having the same account holder. You can probably imagine that if you don't have a single view on your customers, it would complicate understanding the whole picture. In my last example, I would like to share a use case with you about the added value granular segmentation and threshold tuning can bring. We started a project by analyzing the customer's current segmentation model, and it appeared that there were only 2 customer segments, personal and commercial. In this example, we looked at one particular rule, large total cash transactions, that had a low productivity rate of only 4.9%. In other words, out of the 100 alerts produced by this rule, only 5 were good alerts, or in total, out of the 4,753 alerts generated, only 233 were true positives. We then used a clustering technique to identify a more granular customer segmentation model, and we then distributed the results of the same rule to that new customer segmentation model. What was striking was that the majority of the 4,700 alerts were generated for large personal consumers, for example, wealthy individuals, and large businesses, for example, businesses that transacted with large volumes. But most of these alerts were false positives. Their businesses were just usual for them, but not when compared to other personal and commercial customers. As a final step, we tuned the thresholds by setting and tuning them per customer segment and reran the model. The result was astonishing. For large consumers, the alert volume dropped from 3,000 to only 80 alerts, while the productivity even went up from 3.5% to 8.8%. And while for large businesses the productivity dropped from 5.5 to 3%, the alerts that had to be investigated dropped from 952 to only 66. And although in total the volume of alerts increased to 5,300 alerts, the productivity had gone up to 20.5%. This meant not only a reduction in false positives, but also an increase of true positives. And with that, it completes my presentation. Thank you for your attention.